Welcome to this episode number 101 of your next trade call today. Yes, we are back. The S&P, the Nasdaq are back to the levels pre-Liberation Day. We had a very bumpy month of April. We actually, it was perfect for us as traders. I had a very good month. I don't know about you, but let's look about the fact we discussed last weekend that there was potentially more to go on the way up. Our conviction was pretty low, but it felt very much like the market was squeezy. So what about the market? What has been happening? This is, as always, what we're going to be discussing. We're going to be talking about FX because there are some interesting developments in Asia. We're going to be looking at the earnings season and more. So let's start with a chart of the S&P futures, where we started to see a sell-off just after the Liberation Day announcement, where the market went from 5,700 to 4,800. The reason was pretty obvious. That was the scare of a recession, a global recession happening. And in the meantime, what we saw is the stocks went down. This is the normal, sell-off. But normally what you will see in those cases, you will see investors flying their money into what we call safe haven. And the best of them is obviously the US Treasury, the 10 years. And what happened during that time is actually, if you look between the 2nd of April and the week after, the US 10 years, the yields went from 4% to 4.6%. So what the market was saying is actually, we are scared. We don't want to be owning US assets as we were doing over the last 40, 50 years. So that pushed, Jamie Dimon, the CEO of JP Morgan, the CEO of Apollo, Besant, clearly saying, guys, Trump administration, you need to take a step back. You need to slow down because that's going to be really affecting the economy. So this is not much about, a win of the Liberation Day. This is mostly about Trump administration that had to push back and really lower the tune down because the pressure on the credit market was too big. If you think about, to a certain extent, what happened in emerging market, what happened to Greece 10, 15 years ago, even what happened in the UK 2 years ago, that the credit market forced the politicians to change and to move their policies. So let's look at the S&P. As you see, this is the first move, the leg down. And since then, we have been recovering. So we are back to 5,700 on the S&P, on the futures at the close as of Friday. So we are so back of what has been making the market over the last 18 months, pre-February, pre-DeepSeek. And that's something we're going to be discussing. So let's look about the week-to-date asset performance. As you can see, stocks have been very strong. We are talking 3% on average, and this is across the board except China, because China as well was closed on Thursday and Friday. But as you can see, we are talking 3% for stocks. We are talking flattish kind of for the dollar, a bit of weakening of the US dollar. And we're going to be talking about Asian currencies later. And as well, WTI, pretty weak, so below $60, sorry. We saw on Friday some announcement from the OPEC that they will be putting 400,000 barrels more pretty soon. And as well, that has been a wish of the Trump administration to lower the price of oil in order to have lower inflation. So what about the week-to-date industry performance? As you can see, this is interesting because, as always, I want to be looking at how we have been doing versus the S&P. So this is the S&P here, and you see there's a lot of dispersion between the winners and the losers. And what was interesting is actually in the months over the last 4 weeks, there was a strong correlation between stocks. So by definition, when you have a sell-off, you don't think everything is moving the same. So that means we had roughly a 0.6 beta correlation for everything moving. So if you were thinking that you were doing a bit better as of like 5 days ago, that was not the case. It was about selling, buying. So trading the futures was mostly the case. But we see from this chart here that as the S&P, you get a lot of industries on the left, a lot of industries on the right, that even if the market is now going higher and there's obviously a lot of beta and you need to be long the market, alpha is coming into play. And you start to see some dispersions between the winners and the losers. in terms of sectors performance, as we can see here, obviously the defensive one, healthcare, consumer staples, have been underperforming the market. IT, as you see, is outperforming, interestingly, industrial as well. So if you were thinking not so long ago that a big recession was coming, market has been pushing hard to be buying those industrials, even financial. So those names are telling you that the market is less thinking that a huge recession is coming. What about the rates? Looking at the US 10 year, so we are at 4.3%. So we are still at pretty high level if you think about the what has been happening and the wish as well of the Trump administration Besant to see yields going much lower. So we are probably back to the same level as we were before. What we're going to see later, and there's a lot of supply coming next week, and we do have like the FOMC meeting as well. But overall, you know, we have been trading on the US 10 years between 4 to 4.5%, and most recently between 4.15 to 4.35. What about the Fed funds rates? What are the Fed expectations? We went very recently to 4 cuts expected in 2025, and now what about it? We are talking 3 cuts, roughly minus 0.72, so close to the 3 times 25 bips. And as you can see here, this is pretty much the same as it was just before the announcement of the tariff. So stocks, Fed expectations, bonds, everything is back to square one. Everything is back to where we were a month ago. But in between, obviously, we had a lot of volatility. And as you can see from this chart, from the implied volatility 30 days of the S&P 500, we are still at 22% and above. So we are not back to the levels that we have. And that is another reason why the market could be grinding higher, because what we call the funds that would be selling volatility, so the volatility control, are keen and probably will be selling even more volatility going forward. And that means if you see volatility going from this 22-23% into below, or the 10s into the 18-17, that means those funds will be selling volatility and they will be buying shares. And that's another factor that explains why the market is grinding higher. And as we discussed last weekend, the change of the behavior of the market happened just after the expiry of the month of April. So there's a good chance that we could be grinding for another 2 weeks until the expiry that will be happening in 2 Fridays. So let's look at the technical analysis as always, and that's something that we discussed for starting with the S&P. So that was last week. And as I said, so we were roughly into the 55.50. There was a good chance that we're going to be trending higher. So challenging this trend again that we have, but as well, you know, the 200 moving averages. So you do have like a lot of same factors that tells us that we probably going to go into the 5,800. To me, the important level is 5,830. I will see. For the time being, I don't have any position in terms of futures, in terms of indexes. I don't want to be too early. I know that the market's got this tendency over the last few years to recoup all these losses and then to go much higher, especially with, as we're going to see as well, how the options have been pushing the market. But we have been pretty right in saying that the market is grinding, going higher. That doesn't mean that we have made money out of it, but at least we are not losing money, which is for me always a good thing, where looking at the shorts, I'm not losing. So that's the same for the Nasdaq. The charts are exactly the same. I'm interested into some other charts, looking at the CL1, which is for WTI. The weakness, we can't go above 60 now. It's a sell-off after sell-off. And you saw as well in the months last month that XLE, the energy, was down 15%. So that is true for not only in the US, but as well for Europe. Now looking at the gold, as we flagged, the 3,500 was a big level. We sold off since then. You see this huge candle If you are a bit into technical analysis, you don't have to be that big. I strongly advise you to do all those charts looking on the monthly basis, and you will see some crazy moves on the S&P, on the Nasdaq, and very often those candles are telling you that the squeeze is on. What about, I would like to jump in, not Bitcoin, I would like to jump into the same as before, which is the Fabulous 7. And as you can see, this is the same chart as the Nasdaq and the S&P 500. So more or less, this is the same story as last week. Not much of a change. We are trending higher, and the moves are more or less the same. So let's look about what happened actually for this week. So we got the tariff de-escalation. What is interesting is the hawk of the Trump administration are now starting to come back. So you see Navarro, you see some of the guys, you even see Musk a bit more on Twitter and on TV. So that is telling you that as the market is grinding higher and coming back to where it was before, they are now allowed to talk back. The more you're going to see them talking on TV, the higher the chances are we going to have another sell-off going forward. But as you can see, so this is for the S&P. What happened for the S&P for the week? So this is the first sell-off that we had on the day, which was the GDP for Q1, which was a bit below expectation. But interestingly, the market said rightly so, this is past news, this is lagging indicator. And at the end of the session, probably, you know, some people had the numbers from Google and Google and Meta, I think. I can't remember the two that was. And the market squeezed end of the month as well. So you did have some rebalancing. So we squeezed higher. Then we had a bit of hiccup due to the Apple numbers and the Amazon numbers. But more or less the market then squeezed on NFP. So macro earnings, that was what we identified, and this is exactly what happened. And the earnings are more or less the same as last week in terms of how the companies have been doing. As you can see, out of 357 companies of the S&P, this is the beat on the earnings. So pretty good. Okay, so we are talking the earnings beat have been much higher, EPS much higher than the most recent beat. And for the sales, that is pretty much in line. So earnings season in the US has been really good, better than the expectations. That's the same in Europe. But what I want to flag as well, and I think this is really important for the behavior and explaining how the market has been trading recently, is actually if you listen to Google and if you listen to Meta on Wednesday, what they say is AI is still pretty much alive. Meta said that they're going to be increasing their capex for 2025, and Google said that actually the slowdown in Q1 is just a one-off, and they are still very bullish and they're still expecting capex to be pretty high. So let's take a step back. What happened in February 2025? We had DeepSeek, and the market completely repriced AI, saying, you know, there is risk. It's going to be putting capex much lower. In between, we had the sell-off, we had technology really underperforming. So now, as you saw probably this week, we had the big tech that started to outperform the overall market. And I think this is really important in terms of drivers and how the mechanics and the internals of the market are now changing. We could be back to the same market of growth that has been pushing the market higher. So we had as well, and that's something that we flagged. So that's the same kind of data as of last week, but the market is the same as last week. So there is no change. And as a trader, I want to identify at any point in time how the market is behaving and what are the drivers. And as you can see, this is very important since the Liberation Day. Hard to borrow retail, high beta momentum. We are talking liquid IPO basket. We are talking Momo long. We are talking anything that is retail has been outperforming the market by roughly 15%. So even if retail had a decent exposure coming into the Liberation Day, we saw over the last months really a big push, and that's confirmed with the numbers. So JP Morgan flagged that in the last month, retail inflows in the market was at 40 billion. That is the highest number ever. So on one hand, we get we had the hedge funds really that were degrossing since DeepSeek, okay, since mid-February. Literally, hedge funds have been degrossing and reducing their exposure. And in the meantime, retail has been saying, I don't care, I'm all in. And I strongly advise you to look at stocks like Palantir and some others where actually they are back to where they were just before the announcement. So we are really back to the all-time highs on those names almost, and the story same with Duolingo, for example, yesterday, which has like a 15 or 20% move. So retail is back in force. So for this week, as we flagged, we had earnings, we had the GDP, but more or less the market is in squeeze mode, and that carries on. So what matters now is what's going to be happening next and what we think are going to be the drivers. So obviously we're going to have the tariffs. As always, there's going to be a lot of talks. The longer the talks, the longer the Trump administration is saying a deal is going to be happening, at one stage, the market is going to be actually challenging the Trump administration and say, you need to deliver a deal. But I would like to flag this one, which is, I quickly looked at the US stocks, US companies looking at, so if the tariffs were started to be in place in 2nd of April, that means we are roughly 30 days after. Now I'm interested into understanding companies on average retail, how many inventory days, that means how many days of stocks do they have before it starts to kick in. So as you can see, for the Walmart of this world, we are talking roughly 70 days. So that means for them, it's probably going to be kicking in from the end of May. That is longer for Nike, Adidas, Puma, and all those names. So what we should start to see from mid-May, end of May, due to the lasting of the inventories, and as well due to the effect of shipping, it takes roughly 15 days to 30 days to ship from Asia to the US. That means probably if nothing is coming, the shelves in the US could be a bit empty. So that is for your first trigger. And what happens is, if you think about timing, mid-May is when you do have like the option expiry. In the meantime, I think the market is in control. This is about gamma squeeze. We are going higher and higher and higher. In terms of macro, what do we have? We have obviously the PMI ISM services on Monday, very important. Try to see if ISM, if the services are slowing even more versus what has been happening recently. We do have like some inflation on Thursday, so that would be the New York Fed inflation, and obviously we do have like a lot of central banks. So on Thursday we get Riksbank, Norwegian banks, and the Bank of England. But just before, on Wednesday, we get the FOMC rate decision, where expectations are for unchanged, but actually Trump has been pretty vocal in saying the Fed is always late and they should be cutting. Most recently, this is how the FOMC has been impacting the market for the S&P, so a bit of up and down, and as always, you're going to have volatility on the day. So it's not only the decision that is important, but the talk and how well, what is going to be saying just after. We do have like tons of bond supply coming as well. So we get 58 billion, we get 42 billion and 25 billion on the third year. So a lot of bond supply that explain as well why yields are not going much lower. So tariffs, PMI services, bond supply, FOMC, we obviously gonna have a lot of earnings, less as this week, because this week was the most busiest week of the earnings season. But I want to flag as well something that is really important. This is how the Asian currencies have been trading on Friday. So for us as trader portfolio managers, we are monitoring the market, and what we try to flag and identify is where there is abnormal moves, okay, where you do have like the outliers. And actually on Friday, where most Asian markets were closed, and the currencies were really strong. So we are talking obviously about the Chinese yuan due to the potential talks between China and the US, but as well the Taiwan dollar was very, very strong. And as you can see in this chart here, we had a 4% plus move strengthening of the Taiwan dollar versus the US dollar. So there's a big story there where actually insurers in Taiwan have been holding a lot of US Treasury, and in the meantime, they have been weakening the currency. So if you think about it, there is a good case because they are exporting a lot that the Taiwan dollar should be strengthening. That is really something to keep an eye on, because that means people have positioned for a long time where a trend has been ongoing. So for me, one of the first things that I'll be checking on Monday in the next few days is how those currencies in Asia will be behaving. More or less, market is expecting a plus minus 2.1% move of the S&P for this week. So we do have like tariffs, PMI services, bond supply, FOMC, earnings, Asian currency, and obviously, you know, ID generation, looking at tariffs and what could be the impact in the near future. So this is it for me for this week. As always, you can have access to the 4x4 video series and or the mentoring. We do sessions, Etienne and I, on Zoom. It's a 12 sessions format. We do from quantitative analysis, qualitative analysis, technical analysis, risk management, growing your portfolio. We do options. So we have a framework, and in the meantime, we try to customize the mentoring to your need. If you want to join the trading community, this is Discord. There is a free channel, and there are more than 30 channels beyond the paywall. Any questions, you can send me an email at Greg@Dupont Trading. And this is it for me for this week. Have a good trading week. Bye-bye.